Good evening, ladies and gentlemen. First, I'd like to thank the organizers for inviting me. It's again a pleasure of being here. I will talk about a topic which quite recently has increased or has raised some new attention, namely capital flows and the global monetary order. But first, I'd like to mention that the views I'm going to express are exclusively my own. They do not correspond to those of the European system of central banks or the Österreichische Nationalbank. Back in autumn 2010, I think the traumatic moments experienced triggered hopes for a fundamental overhaul of the global financial system, making finance more resilient, making finance serving society, and above all, reinstating the primacy of politics over global financial markets. So what were the expectations back then? There was expecting that leverage of the private sector would go down, and of course leveraging up of the public sector was widely expected. Second, the crisis was not a run on banks as in the 30s, it was a gigantic run on the shadow banks, and the obvious response would have been to regulate the shadow banking system. Third, rather than, let's say, net capital flows, the mirror image of the current account, it were the massively increasing gross capital flows that were at the center of the crisis, and the expectations was that we see financial deglobalization and end of hyper-globalization. Fourth, those gross capital flows were largely intermediated by large banks, financial institutions that were at the center of financial activities, OTC derivatives, etc. And there was this expectations that those large interconnected banks would be, let's say, would downsize or be broken up because they were, let's say, benefiting from an implicit state guarantee, and they had much lower refinancing costs than smaller firms. And finally, there was a call on top of regulatory reform, fiscal and monetary stimulus, a call for new global monetary order, or in some sense a change in the tectonic shifts towards more multilateral currency systems. And also the role of the US dollar was questioned. Remember, the US dollar has played a crucial role in underpinning the private credit creation of the banks and the shadow banking system. What I'm going to do now is first I want to contrast those expectations we all had with the outcomes 10 years after. Then I will discuss some of the structural inefficiencies of our current global monetary order, and finally, briefly, let's say, present some of the reform proposals of the global monetary order. On deleveraging, and just let me also mention what I find very interesting is, if we recall the recent comments in the press or in the literature, there is not much controversy about the fact that much of those expectations we had were widely disappointed. In 2016 and also 2017, the latest data are from 2016, the world is as leveraged as never before, comprising both non-financial private debt but also public debt. Global debt is now at the level of 225%. On the right-hand chart, you see that the non-financial private debt has tremendously surged already since the 50s, reaching levels of more than 260% in the advanced economies. But we see that the emerging markets have played a crucial role, so in leveraging up of the private sector. So about 2/4 of the increase in global private debt is just due to China. Second, I think these two graphs, you probably might be familiar with the arguments. I still found them find them extremely interesting and compelling. It shows the size of the shadow banking system for 29 countries comprising 80% of world GDP. Just recall that those data are only available since a few years because there was no information when the crisis hit. There was no information on the size of the shadow banking system. And we see that in the run-up to the global financial crisis, the balance sheets of the shadow banks increased in line with the traditional shadow banking system. So the shadow banks, it's a broader definition. You see it, the green line. It's more or less other financial institutions comprising financial institutions without banks, without insurance companies and pension funds. Well, it's interesting here that when the crisis hit, the increase came to a halt, but thereafter there was again a further increase, while we saw a decline in the size of the banking system, also as a consequence of regulatory reform. This increase in shadow banking is not only due to China, it has also a lot to do with what has been happening in Europe. This is from the shadow banking monitor of the ESRB, and we see, if you just look at the orange, or the yellow area, the shadow banking system of the Euro area, we see that the size since the crisis has actually doubled from about $15 trillion to $33 trillion. And I think this was widely anticipated because the criticism on the focus of the regulatory reform agenda of the G20 and the European Union was always that it's a focus on banks. It's entity-based rather than activity-based. Because here we only see, let's say, an entity-based approach, but shadow banking always also includes activities, repo transactions, etc. And the Capital Markets Union project, for instance, of the European Commission, actually fosters shadow banking activities. Another issue is the size of the banks. Here we compare the top 20 largest banks in Europe, as the European Union, United States, and China. Between 2007 and 2017. What's interesting here that Chinese banks, the yellow bars, have overtaken European banks. And here, if you look at the right-hand chart of this very simple concentration measure, top 5 largest banks in percentage of GDP, we see that concentration has somehow declined in Europe, but it has increased between 2007 and 2016 and then 14 and then declined thereafter. Some decline we have seen in the United States and tremendous some increase, so to say, in China. This graph shows the cross capital flow dynamics for a group of countries. It's 43 countries comprising 87% of GDP, before and after the crisis, inflows and outflows in percent of global GDP. And these graphs are usually used as arguments that we were undergoing a strong financial deglobalization. And I think this major hypothesis I'm going to challenge right now. What we see is here that Europe, it's the blue bars, the advanced Europe, has had the largest increases in capital in and outflows before the crisis, and those were not visible in the current accounts, and also felt the largest retrenchments. I think these graphs probably better show what was going on. They show the same data, but in percent of domestic GDP. And we see here the blue bars, these strong increases and of inflows and outflows. And those they reflect two things. First of all, you might be aware this round tripping across the Atlantic, large European banks increasingly were, let's say, tapping the US dollar money markets, transferring those funds to the European headquarters, and then purchasing again so-called safe assets, mortgage-backed securities with AAA ratings that finally turned out to be not that safe, that became toxic in the course of the crisis. And again, the international organization, they just looked at the current account and not at the cross, as it looked at the net flows and not at the cross flows. Again, this is interesting. These are only emerging markets, but I show this because we in our bank, in my division, we also have a focus on Central and Eastern European countries. And you see this tremendous increase in capital inflows into the region. And I mention this because Central and Eastern Europe was the region which was hardest hit by the global financial crisis. If we look at the flow categories, we can see disregarding cross-country heterogeneity, that the slowdown, this retrenchment of flows is exclusively or almost exclusively explained by so-called other investment. These are banking flows. Foreign direct investment has remained rather resilient. And I now show the balance of payment statistics don't allow us to, let's say, to see who the counterparty is. So we've looked at the BIS statistics, and we see here very important things. First, the retrenchment of capital flows is almost exclusively related to the role of European banks. But banks in Europe still hold most of the global cross-border claims, more than half in the world, but you have to think of the fact that here also the European Union cross-border claims are included. To conclude this part, I think it's rather than, let's say, the argument, I think, of financial deglobalization is not a very valid one. What we see is an extraordinary unwinding of, let's say, transatlantic cross-border flows in the core as a consequence of the crisis on the one hand, and at the same time the ties of flows of US dollar flows between the United States and Asia have increased. And the second issue is that this retrenchment we are seeing in the cross-capital flow dynamics is also a sign of fragmentation in the euro area, because the core banks reduce the cross-border claims vis-à-vis the periphery. So it's a sign of fragmentation, or a sign of the fact that fundamental institutional reforms of the euro area have not been accomplished yet. Another expectation was the call for a new global monetary order, a new Bretton Woods. It was brought up by Nicolas Sarkozy, Gordon Brown, and others, Joseph Stiglitz. The Bretton Woods came, let's say, returned as a fascination moment in 2008 as a sign of stability. It were the heydays of Keynesianism. But interestingly, at the turn of 2008 and 2009, all of these more radical ideas, so the pressure to think the unthinkable was not strong enough, because banks were already bailed out, were in the process of being bailed out, and the harsh economic consequences of the crisis, they were underway, but they haven't been felt yet. But in early April 2009, Governor Su, the governor from the People's Bank of China, surprised the world with his own ideas about a global monetary order. He asked to replace the US dollar with a new international currency, which should be the IMF's SDRs, special drawing rights. Again, the flirtation of the G20 with these more radical ideas was a very, very brief one, and none of these, let's say, ideas made it into the official documents. Remember in autumn 2008, or even earlier, the big risk of the world economy identified by economists or international organizations was the large current account deficit and the threat of an abrupt reversal of the value of the dollar. Surprisingly, after Lehman, the value of the dollar surged. This had to do with a repositioning of the banks and financial intermediaries. And despite of the declining role of the dollar in world GDP, it declined from 18%, from 18% to 15% during the last decade. The dollar has remained his very central role by several metrics. If you look at the foreign exchange reserves on the right-hand side, so United States is the red bar, you see a decline of reserve holdings of the dollar, but this is a phenomenon we are observing only since 2016. Surprisingly, is also the increased role of the dollar with respect to outstanding debt securities. What is not here mentioned is the invoicing currency, because we don't have data available for 2007. But here the role of the US dollar is still a very important one. It's about 40%. The euro here has a share of 37%. And what is not good visible here is the red bar here. With regards to the renminbi's role as a reserve currency, the latest figure I saw for the second quarter of 2018 was 1.8%. So despite of the internationalization strategies of the renminbi is not really a very important reserve currency up to now. Here, this is from the a paper from the BIS, which shows that the claims of all banks vis-à-vis emerging Asia have been rising since 2007, and a large part of these claims are in US dollar, which is extremely worrisome because this encounters currency mismatches and huge risks for emerging Asia. Now we'll briefly discuss some of the characteristics of the current monetary order. I skip the issue of exchange rate volatility, but I think the current monetary order is inextricably linked to capital flow volatility. The second, we've seen a massive increase in reserve accumulation from the side of emerging markets, which also incurs some kind of risk. And then the well-known phenomenon of asymmetry in the adjustment mechanisms between surplus and deficit countries. And finally, the asymmetry between the United States and the rest of the world. Quite famously, I'd like to mention the word of Helene who argues that, let's say, the global financial cycle is determined by the monetary center, the United States. I think capital flow volatility, boom-bust cycles in capital flows are well visible when looking at emerging markets. I here depicted the net flows for sake of time, but you can clearly see here, for instance, look at the yellow bars. This is Asia excluding China. You can see the Asian crisis, large capital inflows superseded by a sudden stop, strong outflows, a collapse of the banking system, of financial markets. Quite recently, after the financial crisis, the emerging markets, as a consequence of monetary accommodation of the central countries, have received capital inflows of more than $2 trillion US dollars. And the taper tantrum has led to a reversal of capital flows. And I think it was in 2014, the central bank governor of India, Rajaram Rajan, was complaining about the breakdown of cooperation in monetary policy. Reserve accumulation of foreign exchange reserves. This is also very an astounding picture. You see here the red line, the share of foreign reserves in percent of own GDP, and then Asia, Latin America, China, and Central and Eastern Europe. And you see here that emerging markets have accumulated foreign reserves by massive amounts, starting from about 7% up to 25% around 2011 and then declining thereafter. And there are three reasons for this reserve accumulation. First, self-insurance mechanisms. So the emerging markets are subject to volatility in commodity prices, interest rate changes that occurred very abruptly, and then capital flow volatility. And so foreign currency, so emerging markets accumulated those reserves for a self-insurance mechanism. Another not so important reason is the mercantilist, let's say, motive, manipulate the exchange rates in order to have, let's say, use the exchange rate in order to avoid further appreciation of the dollar. But there's another very important new phenomenon, which says that the countries, they cannot, if they have volatile capital inflows, massive capital inflows, they need to stem against the appreciation pressures. So what are the costs of reserve accumulations? First, quite clearly, opportunity costs for the accumulating countries in terms of foregone investment and consumption. And second, it has a globally deflationary impact. Here we see what has happened to the current account after the financial crisis. As we'll know, there's a lack of market mechanism that sanctions surplus countries. It only sanctions the deficit countries. What we see is that after financial crisis, we've seen a painful downsizing of current account imbalances. But what's interesting is the role of the Eurozone, the blue area. And for the first time, I think since many years, in the first half of 2018, China has had a current account deficit. So the Eurozone is increasingly taking over the role of China as kind of counterpart of the US current account deficit. Here you see the Euro area again. The volatility of capital flows, boom and bust cycles, has, let's say, triggered a literature which refers to an older discussion about the push and pull factors of capital flows. The most interesting, from my point of view, stems from the work that was done by Ellen Ray. She argues that if the push factors of capital movements are dominant, then the Mandel's trilemma is morphing into a dilemma, meaning a country can only decide between autonomous monetary policy or capital, or open the capital accounts. So I think, irrespective of the exchange rate regime, the room of maneuver, if you have an open capital account, there's no room of maneuver for autonomous monetary policy. This is a chart from our own research where we also show that the global factor, financial factor, is the predominant factor. And we also see, for instance, that volatility in capital flows quite recently have increased. So if I just want to mention the arguments or the responses to this capital flow volatility literature, I think on the first, there is still this first best argument. So countries can best benefit from open capital accounts if they fulfill several prerequisites. The problem is that those prerequisites are getting longer and longer after each financial crisis. The second point is that, for instance, the IMF has adapted its very positive role on capital account convertibility towards a more, let's say, nuanced view in the aftermath of the financial crisis, recommending sequencing of capital account liberalization. But now it has let's say, done a more radical view towards recommending capital flow management measures. Branding capital controls in a different way to give the impression that they are more neutral or more technical. And here, I think it's very interesting because the first line of defense in all these arguments is are the macroprudential measures. And I think macroprudential measures can be very useful, but for instance, if capital inflows or outflows are not intermediated via the banks, then capital flow management measures, then macroprudential measures are not effective. And finally, I'd like to mention the revival of an old literature, in particular also work of the International Monetary Fund, that goes beyond the concern of autonomous monetary policy or financial stability issues. The argument here is that actually in retrospect, with hindsight, the connection between capital flow mobility and growth is very weak, and there is research done by the IMF showing that income inequality can be related to capital account liberalization, and also arguments including work that was done by Özlem, that, for instance, taxation from capital to labor is also related to free movement of capital. If I may, 2 more minutes. Sorry.
Okay, brilliant.
Yeah. On the reform proposals, I think this is a very topical issue given the partial retreat of the United States from international cooperation and also the efforts of the European Union to set up a kind of financial purpose vehicle to facilitate trade with Iran. I think there are some ideas that are being discussed in international fora, for instance, to provide international liquidity by expanding the global financial safety nets. And there are also calls for, let's say, moving towards a more multipolar world. Just here, I'd like to mention, and the usual candidates are, let's say, Europe and Euro area and China. But I think the problem here is it's not so clear whether a multipolar world can make the world safer. Just think of the reserve currencies of the. If you think of these 3 economic areas, they have to be interchangeable. It would mean that China would be forced to completely open up its capital account, which it started already, and it had to put a brake on this account liberalization of the capital account. And I think the problem is if, for instance, there is a small change or the perception of a change of fundamentals in one area, let's say China, a financial crisis, then you will have volatile capital flows, abrupt capital outflows, similar to what we have been observing in the Eurozone, because before the so-called Euro crisis, or before 2008-9, the sovereign bonds, they were more or less interchangeable. And this interchangeability has disappeared. So I'm not so sure whether this is a project that will provide more safety. And I think there is need for much more research on how, on capital flows, on the way how they might be implemented, which kind of capital flows, what are the experiences of other countries. And I herewith conclude. Thank you.
Thank you very much.